Hi, this is Shane with The Rational Trader. It is Thursday the 17th, and we have a case today where trading in the multiple markets helps smooth things out a bit. I took another max loss today in CL. We're going to talk about that in just a minute. 17 ticks in gold for a total of, what is that, just plus 40. Where is it? Activity log. All symbols non-sim. Yeah, so plus 40 today. Actually, while we're here, let's take a look at this because we are running an experiment in January on the analytical process, and the results are kind of interesting here because we're seeing sort of differences between oil and gold. So we're going to come back to this. Let's take a quick look at the gold trades. Here's the open. So we get short here and get we're trailing by 15 ticks and get taken out there, which as I saw this felt like, oh shoot, we're trailing too tightly, but the market starts to thrash sideways there. There's a hint more there to get, but that's not a bad exit. And then let's see, the market trades down here so long that the point of control moves down, so then we stay at it there, and then as we reach the top of the value area high, we get a short signal to get in right there at 92.20. And same thing, that's a nice fall. That should be 15 ticks. Is that a 15 tick trail? Let's see. 89.10, 90.10. That seems like more than 15. Let's take a look at that. Trade activity log. No, that's the wrong one. Attach trade window to chart. Oh, it's a 20 tick trail. All right, so that should be 15, I believe. Let me check here, actually, to make sure. I don't have that replay program on the trading computer, so let me check here on the replay program on the development computer. Give me one moment. Okay, so no, I was incorrect. It does show a 20 tick trail. So there must be enough cases where we get stopped out on 15 but not 20 for it to work out for us in that case. So this is set up correctly. The difference was just in the replay, and again, I'm sorry I can't show it on screen here. It's on a different computer. It was with a 15 tick trail, it's 510 ticks across 60 trading days with 17 max loss. And then let's run 20 real quick. And this is what it's supposed to be, just because the number's higher. It is 572 ticks. Same max loss, 17 days in 60 trading days seen. Okay, so that's the data we're using to make the decision on how to set it up. Let's close this. That. All right, now, so if we recall, we are doing an experiment in how we analyze the output of the machine learning system, and both gold and oil are using this bottom half, which is more aggressive but theoretically more relevant. So I say theoretically because we just don't know. Previously, we were taking 6 4-week buckets and then looking for common behaviors that yield a nice profit with the fewest amount of trades. And the concern was that we can be the character of the market can change, and then we're not sort of keeping up with how things are currently behaving. And so I'm using a different method that uses just half that amount of data. And that's what's being tested here in January. In oil, when we look at oil, it's not doing anywhere nearly as well as the first method. If we look at our trade activity log, in total, we climbed up to 21, and now we've come back down to 13. That's a fairly big drawdown. Some of that is related to moving into the euro into production a little too quickly, but let's just take that out of the discussion, because the oil, the way oil's been behaving recently has not been wonderful. The CLG. Yeah, okay, so we started trading H today. G is what we've been trading. So what we're going to do is we're going to look at from the beginning of the year. And it's not horrible, but it's not great. And it's dramatically different when you look at the previous 4 or 5 week period, just in terms of the number of days where you're hitting this larger max loss number. The thinking is that, or at least what the analysis shows, is that there's more opportunity if you're more aggressive, but you are going to take more max loss days. The problem is that with a higher ratio of these loss days or max loss days, you have a greater probability that you're going to get more of them in a row. So if you just think about it, we're talking about the difference between, say, 20% and 30% in terms of the loss ratios. So you could think of like take just like a single die and just roll it. And if you rolled it and if you come up with a 1, that's a max loss day. So about 1 in 6 times you're going to, overall, that's what you're going to see. But if you double that, then, let's say if you roll a 1 or a 2, then either of those would be a max loss day. And if you just roll a bunch of times, you'll see there's long stretches where you get a bunch of 1s and 2s in a row or near each other. And that's the concern here. All right, so we have a couple more weeks in January to finish this off, and then we'll see. Now this is oil. If we look at we're using the same analytical approach for gold. If we look at gold, GCG9 from January, this is quite a bit better actually than previously. So if you just add this up, from January, this works out to about 300 in total from the beginning. 1126. It's plus 50. So you're at scratch or on a gross basis. Since January, it's plus 300. So this is when we change to the more aggressive approach. And so either we don't have enough data to make a decision. If I had to make a decision today, I'd say, stay with the aggressive for gold and switch back to conservative for oil. I'm going to continue to run this for the next 2 weeks and then decide. That was my original plan. I don't see any reason to change that. But there's one important thing to note is that if you're just only trading oil, then if you look at this week, really, you could have considered stopping after Wednesday, because basically what we do is if you get 2 max loss days in a row, you stop. This was not quite that. It was sort of a half loss and a half loss, and then here's a max loss. This was the 16th. Today again, we switched contracts. So we get into the H. Today again, you have another max loss. So normally that's the signal. Okay, you got to stop. You got to manage your risk. If I was trading oil by itself, that would be what I would be doing. Since I'm trading multiples, you really sort of do that at the aggregate level, not just at the individual security level. So we have, we go back to here, and then look at the loss for the week against the entire account size. So this is not that bad in terms of a loss week. It's 120 plus it's minus 240, so that's 2.4% against a $10,000 account. So it's nothing to be concerned about. All right. But if you're only trading oil, typically that you're only trading one market. Typically that you're you don't, well, not typically, but you don't have the opportunity to offset losses with gains in other markets. That's one thing. But you're often trading with a smaller account because you can't afford to trade multiple markets. And if that's the case, then you have to very closely manage that, to manage your risk. All right. And the assumption is that the way the market is behaving is just not in sync with the patterns that we're looking for at this point in time. And so just stop and then pick it up. You start again on Monday. And that's how you manage your risk. There's a daily risk limit, which the actual trading system will enforce, as can your broker with a daily risk limit. And then there's a weekly risk that you have to manage as a trader, or as a I don't know, if you're using this, you're not really a trader anymore. You're more like a system manager. But as that person, you've got to manage your risk on a weekly basis. I don't have anything in here that will stop you if you exceed a certain amount on a weekly basis. Okay. In the yen, there was no trades, so we're getting signals now. But I'm doing the conservative approach here. And in general, there appears to be less movement, so there's less opportunity in that market. Looks like there was a nasty fall here, but I've stopped trading by then. That's interesting. I stopped trading at 1040, so that's something to watch. The music's too loud. Hold on. I stopped trading right there in the yen. Big fall there. That's interesting. I have to pay attention to that and see if that's a one-off, or if I'm missing out on some regular volume. I analyzed the volume before I chose the trading times. So what they showed was that the this first hour and a half has the most opportunity, starting from 525 here. Let's see. Looking at this, you can see what happened here is that we'd like to get a signal up in here. The point of control is getting in the way there. We're not going to take a trade with the point of control there, and then we thrash sideways in a fairly ugly way. So we stay out of trouble there, which is good. That's good to see. We would have liked to have seen something right there. The machine's looking, so that's the right thing to be doing. Okay, but again, this is running conservative, so I sort of expect less, and it'll be curious to see if what it turns out is that you're better off conservative all around. Okay, we went to a more aggressive posture to try to catch more of the moves that we saw in oil. Thus far, that's not working for me. I've got a couple more weeks to test that out, and then we will make a decision on what to do. All right, that's it for today. Take care.